Alright, so you want to start investing in the stock market but have absolutely no idea where to begin. Maybe you've heard people talking about stocks, dividends, and passive income, and you're thinking, this all sounds great, but where do I start? Well, today I'm going to walk you through everything step by step, and by the end, you'll have a clear roadmap for 2026. No fluff, no hidden sales pitches, just real actionable information that you can use right now. Let's start with the why. Understanding your reason for investing makes everything else click into place. Most of us trade our time for money every single day. You show up, you work, you get paid, stop showing up, and the money stops too. That's called active income. But there's another way to earn money. When you own assets that generate returns, that's passive income. Stocks can do exactly that for you. You buy a stake in a business, it continues operating and generating profits, and you get rewarded as an owner. That's the power of wealth building. Simply put, a stock is a small ownership stake in a real company. When you buy a share, you become a partial owner. As the business grows and earns more money, your ownership stake becomes more valuable. It's genuinely that straightforward at its core. Now, before you can buy a single stock, you need to open a brokerage account. Think of it as your connection to the market. For beginners, platforms like Robinhood or Webull are popular options. If you want more features, Fidelity or Charles Schwab are excellent choices. Simply go to their website, fill out a short application, verify your identity, and you're in. Step 1 is done. Now, before you put a single dollar into any stock, you need to decide what kind of investor you want to be. The first is dividend investing. This is popular for people who want steady, reliable income from companies that share their profits. Look at the dividend yield, the payout ratio, earnings history, and dividend history to find reliability, like Coca-Cola has for decades. The second style is value investing. You're trying to find companies whose stock price is lower than what the business is actually worth. One tool is the PE ratio. A lower ratio generally suggests a stock might be undervalued. Value investing requires patience and research. The third approach is growth investing. Here you're focusing on companies that have enormous potential to expand rapidly over the coming years. Look for industries like artificial intelligence, automation, robotics, and clean energy. Early entry is where the biggest gains typically happen. The fourth style is passive index fund investing. An index fund is a bundled collection of stocks that tracks the market, like the S&P 500. The beauty is simplicity. You invest regularly and let compounding do the heavy lifting over time. This is what Warren Buffett recommends. Now is right now a good time to invest? Markets feel high and crashes seem possible. But nobody can time the market perfectly. Staying invested over long periods beats trying to jump in and out. If a correction happens, that's an opportunity to buy at lower prices. A practical strategy is dollar cost averaging. You invest a fixed amount at regular intervals, regardless of market conditions. When you're ready to make your first purchase, start small. Building the habit is more important than the initial amount. Open your account this week, decide on your style, make your first small investment, then keep learning and growing. The goal is long-term financial freedom. The most powerful thing you can do for your future self is start now. Let's get you started.